again, this is Patrick Findaro, Business Development Director with Visa Franchise. Thanks for everyone for coming to our webinar today. We have a special guest that I'll introduce, Luca Cancellieri from Prager Metis, who's a CPA, and we'll talk about more of an accounting 101. What are the important aspects to understand as you open up a franchise in the United States? Before I turn it over to Luca, I just want to give a brief introduction of Visa Franchise. We're based in Miami, Florida, although we have offices across the United States, Latin America, as well as Turkey. We have a portfolio of about 90 franchise businesses and licensed businesses that we accumulated this portfolio after analyzing over 1,200 opportunities. Most of our clients are seeking investor visa, but not all. Many of them are just looking to invest in U.S. franchises and businesses in the United States. Today, we've advised clients from 35 plus nationalities. In our firm, internally, we have Portuguese, Spanish, Turkish, and Chinese Cantonese language capability. Our team has deep experience in the financial markets, as well as working with some of the largest franchisors in the world. We're very focused on what we do. We help find and analyze franchises that qualify for investor visas, whether that's the E2, L1, or EB5 visa. And we do this throughout the United States. We've had clients move to California, Texas, Florida, Colorado, Illinois, New York, New Jersey. The list can go on for quite a while. And we're constantly on the search for finding the best opportunities for our clients over a personalized franchise search. Feel free to reach out. Here's our contact. But really, I want to turn it over to Luca, who's our special guest today, who will give an accounting 101 for your franchise and investor visa. Thanks. And any questions you have, please use the dialog box, or you can also send us an email at info@visafranchise.com.
Here I am. I hope everybody can hear and see me well. Thank you so much for the opportunity today of being here, Patrick and Visa Franchise. My name is Luca Cancellieri from Prager Metis CPAs LLC, based here in Miami, Florida. Let me give you a little introduction on our company. Prager Metis is an international accounting firm, top 60 in the US and top 10 international level. We have more than 70 partners and principal, more than 400 team members, and 13 offices worldwide, including New York, New Jersey, Los Angeles, Miami, and London. We're able to provide a full range of service, accounting, audit, tax, advisory, and international services. We have a level of expertise and a full range of a level of expertise and a global presence that are unique. We have staff other than English and Spanish, speaking Chinese, Italian, French, Portuguese, Turkish, and even Russian. Therefore, we can better serve a diverse domestic and international clients in a wide range of industries. Let's start with our presentation. Today's topic is Accounting 101 for your franchise and investor visa. So we're going to give an introduction of doing business in the United States from an accounting and tax perspective. Here we go. So before starts, let me give you an overview on what are we going to talk today. Introduction of United States legal system, entity choice and formation, entity income tax, and then we will go deeper into detail for individual income tax. And then I would like to conclude my presentation with some hint and some statement about franchising to and within the United States. Here we go. Let's start with, United States legal system. The United States has a federal system of government. We have 3 levels, nation level, so federal level, state, and local. Local laws are those made by cities and county that applies in those geographic region. States have their own state and local laws that apply. There are some areas of law that are governed exclusively by federal law, such as patent and copyright. Other laws primarily set by individual states. We have, for example, contracts, employment, relationship, and also sales transaction. Then other areas of law are governed by both federal and state law. Let's turn now to entity choice information. And let me tell you something before this topic. When doing business in the United States, foreign companies should be aware that they are subject to these two parallel systems, federal and state, which often differ depending on the state and the region you decide to start your. So choosing the proper legal entity for your business is one of the most important initial decisions. As an owner, your personal liability, your legal rights and obligation and tax responsibility are affected by the business entity you decide to select. Making an informed choice at the outset can impact the long-term success of your business. So understanding the differences between entity types, I can tell you, can be very confusing and time-consuming. You might find that two or more formation options seem equally satisfying your needs, but making the final choice quickly in a rush based on price or on what seems most common in the marketplace you are, it's not usually advisable. Common type of domestic business entities in the United States are partnership, limited liability companies, so LLCs, and corporation. Each business form has its own benefit, and the choice of the form depends on case-specific legal and business factor. Following what we said before, each type of business entities then must be formed according to the laws of the state in which the entity is formed. All entity types other than partnership require organizational documents to be filled with the state government. So let's turn the attention on the first common type of domestic business entity, that is partnership. What is a partnership? A partnership is an association of two or more individuals or entity engaged in business for profit. So it's a business, we can say it's a business arrangement in which two or more people own an entity and personally share its profit, losses, and risk. In fact, partner are jointly and severally liable for all the debt and liability of the partnership and for all wrongful acts of any co-partner acting in the ordinary course of the business. Let me give you a practical example. Partnership may not be the optimal choice for startups, for example, that are looking for fundraise. Why? Because most of the time investors don't want to be subject to unlimited liability as a member of a general partnership and maybe prefer to invest in an entity that limits their personal liability. We're keeping mentioning liability and liability. What is the liability here in the United States? Liability just means that if there are unpaid bills or the company loses a court case after, of course, a judge decision, then you as a shareholder, member, partner, owner, whatever you are, must pay up from your personal fund or asset, like your bank account, your house. That's why this concept of limited the personal liability is very important. A partnership can be formed by a verbal agreement. There's no need for documentation or arrangement at all at the beginning. However, there might be subsequent disagreement among owners at a later date. So it makes sense and recommended to create a written document that states how certain situations are going to be. This partnership agreement should at least cover some important topics. For example, the right and responsibility of each partner, whether a partners are designated as general partner or limited partners, the proportion of the partnership gain and losses to be apportioned to each of them, and then also procedure and provision regarding how to add a partner, terminate a partner, liquidating the partnership, or dissolve the partnership. In addition to the partnership agreement, all the partners must engage in a number of formation activities that are common to all types of business. And these actions include register the business name, obtain an ID number, obtain a license required by government where the partnership plans to operate, open a bank account, of course, in the name of the partnership, and file an annual informational return, so the tax return, with the IRS, the International Revenue Service, that is the United States National College Agency. Limited liability company. This is another kind of entity here in the United States. LLC are formed at state level. In most states, a business entity search online on the Department of State website will tell us whether our intended business name is already used, in case we need to choose another one. LLC, and then we will see also with corporation, can be organized easily online. After organizing, the founder must satisfy some statutory publication requirement. For example, it needs to publish a summary of your business article organization or qualification in 2 newspapers in the state of where the business is performed for 6 consecutive weeks. LLC are not corporation. They do not involve many of the formalities that are required when managing a corporation, and we will see that later. For example, LLC don't need to issue stock, are not required to hold an annual board meetings, or they don't have to keep written minutes of those meetings. LLC are very flexible, but at the same time, they are complicated entities. Under the default rule, so by default, an LLC with 1 member does not exist for federal tax purposes. So that means this entity is a disregarded entity and is taxed at the personal level. So there's no tax return to file. The income produced and the expenses that we can deduct are used on a personal level. And an LLC with more than 1 member, then it's by default a partnership. If we file eventually an IRS form, an LLC can become later a corporation, S corporation or C corporation, and this is for tax purposes. The members of an LLC are protected to the extent on their investment. So they are liable to the extent on their investment. But if there are no manager in the LLC, they might have legal responsibility for action that the company, the LLC, has taken in the course of business. Even if there are managers, sometimes the member may or may not have further liability for their action or negligence. Corporation. We have mentioned corporation so far. Let's now take a look into details. Corporation are similar to LLC because they are formed at a state level. And again, like a quick search online on the Department of State website can reveal if the name is already used. Eventually, we will switch it to another one. And if you recall the publication requirement that I mentioned on the newspaper for 6 consecutive weeks, for corporation, this is not a requirement. So corporations are not subject to this publication requirement. The birth of the corporation is the filing of the certificate of incorporation with the Department of State in which the company will operate. And then an initial organization meeting with the person that incorporates the company must be held for the purpose of adopting statute, electing directors, or transacting any other business after that. It's recommended that a qualified attorney always oversee the management of your corporate documents. And of course, it's also important and imperative that any new business seek the advice of an accountant or a tax professional prior to making important business decisions, including the entity formation. And let me just add that also the corporation need to keep a record of book and tax return, and also other documents containing the name and the address of the shareholder, the number of the shares, the class of shares held by the shareholders, and also the date when they became the owners of those shares. So it's a little bit more complicated than partnership and LLC. All United States corporations have to file a federal tax return each year. So a corporation is an entity that needs to file a tax return. The shareholder, and also let me add, some of the corporation, depending on the state where you operate, needs to file a state tax return. So not only a federal, but also a state. That's why I wanted to start my presentation with these separations. Depending on the state, you might be required to file a federal for sure and a state optional. The shareholder of a corporation are not only liable, are only liable for the amount of the capital they are committed to invest. So this is similar to the LLC. If they have not paid their share of capital and the corporation, for example, goes bankrupt, they may have to pay up the unpaid portion. After the formation, a corporation might elect to be treated as an S corporation under the section 1362 of the Internal Revenue Code. By default, business corporations are always a C corp at the time of the formation. If all the shareholders qualify, as we said, and they want and they decided to, they can elect to be S corporation. There are certain limitations. There are some benefit, of course, and cost, but there are also some limitations that can affect, for example, an international taxpayer here in the United States. For example, with an S corporation, we cannot have different kind of class of stock. So we need to have just a single class of stock other than voting. There is a limited number of shareholders, only 100. Only individual and certain non-for-profit corporation can be shareholder and can be shareholder of an S corporation. So only those people can do the election, and those are citizen or resident of the United States. Talking about LLC and corporation and their diversity and their similarities, let me just mention as a reminder that some state licensing requirements might exactly require a corporation as opposed to an LLC. So there are some requirements that says, hey, like you cannot file an LLC in the state, but you need to file a corporation. So you need to file your tax return and pay taxes on that. One of the states, for example, is California. We had an example and a client a few years ago. So just to keep in mind as a reminder, some of the law are very strict. So maybe the entity choice and the entity formation are not so flexible. So we need to respect the rules according to the state. And finally, talking about kind of entity in the United States, we can, when we start our business, we can start it with a branch of a foreign company. So we have already a foreign company in our homeland, and then we create a branch in the United States. So this is just an extension of our company in our homeland. As I said, it's not a separate entity. In this case, the branch, it's not a separate legal entity, conferring limited liability of its owner. So the branch has all the type of liability without any limitation. And this is what different from LLC and partnership. It will be subject to the jurisdiction of the courts of the state in which it operates, of course, and possibly also other US courts. One of the tax reasons we don't recommend to use a branch is that the US tax authority can then require complete detailed information on the worldwide operation of the company, of the non-US company, I'm sorry. So our homeland company. So then also we need to obtain federal tax ID number, state, and probably also a city tax ID numbers. And also we need to file a tax return. So after giving you an idea of which can be the company that a client can create and start in the United States. And again, we said partnership, corporation, LLC, and a branch. Let's take a look at the income tax from a business standpoint first, and then we will see individually. So as we said, LLC will be treated for tax purposes as partnership, S corporation, or C corporation. For the purpose of the audience of this presentation, we will not get into details for the S corporation. As we said, there are some limitations, maybe we can discuss further, but there are some limitations, and usually international client don't use S corporation, are not allowed to use S corporation as well. Therefore, let's take a look on how partnership and C corporation work and are taxed. Let's start with partnership. Partnership itself, this is a great news, does not have to pay tax. Rather, income and flow through to partners schedule K1. So let me explain you better. Partnership doesn't pay taxes. We need to file a tax return, and then income and expenses will flow through our personal tax declaration, personal tax return through a schedule K1. So I pay taxes through my individual tax return. The annual federal tax return required is Form 1065. The original due date is the 15th of the third month following the fiscal year end, and an extension can be obtained for 6 months, and is an extension of time to file. Partnership may make tax-free distribution of money or other property to partners. And if a partner receives money for service rendered to the company, those are guaranteed payment and are taxed as ordinary income to partner. But at the same time, the IRS let us deduct these as an expense for the partnership. Let's now turn on corporation tax. C corporation, as we said, are separate tax paying and tax reporting entities from the owner. There is no flow through our individual tax return. So a C Corp is an entity that pays taxes. The annual federal tax return required is a Form 1120. In this case, the original due date is the 15th of the fourth month following the fiscal year end. So if we have a C Corp and the year end is calendar year, December 31st, then we have until April 15 of the following year to file a tax return, like as happened for individual tax return. So April 15, and we can obtain an automatic 6 months extension of time to file. Again, this is only an extension of time to file, does not extend the time for paying the tax. So April 15, we still need to pay our balance due in order not to incur in penalty and extra fee and interest. Since C Corp pay taxes, here, as you can see in the slide, this is the tax formula for a corporate return. We calculate the total income minus all the allowable deduction that the IRS let us deduct. Then we get to the tax income before net operating losses and special deduction. And after subtracting these special deduction, we get to the taxable income. Here we apply the corporate tax rate. Therefore, 2018, with the new tax law, it's only 21%. So let me just mention to you that one of the issue with C corporation has always been the double taxation. This is one of the important tax implications when we decide our business entity, and also in case and in phase of paying taxes on April 15. Double taxation means that a C corporation can be taxed at a corporate level and also an individual level. Let me explain you better with an example. So in case of C Corp, we have an income of $100. As we said, we are subject to a 21% corporate tax rate. So corporate tax would be $21. The after-tax entity income at this point would be $79. Then in case of distribution and dividend, to the owner of the C Corp, the taxpayer at individual level on his individual tax return will be paid, will have to pay individual tax. Assuming 15% of the dividend rates, so 15% of 79 is 12, the individual after tax cash, it's 67. So starting from 100, we are taxed at corporate level 21, and we are taxed at individual level of the 15% of the dividend rate, assuming 15% dividend rate, it's 67 my after tax cash. In case of an S Corp or LLC, then partnership, our income is still 100. We don't have corporate tax because S Corporation, LLC, and partnership don't pay corporate tax. It's a flow through, remember, to your individual tax return. So the after-tax entity income is still $100. We haven't paid taxes yet. Then this $100 will concur to my global income that can come through salaries, dividend, interest, my foreign income from my homeland business, or I have real estate or building or rental property everywhere in the world. So this $100 will concur to the global income, and then it's taxed to an individual rate. In this case, I put 40%, of course, this is the maximum. And then our individual after tax cash is 60. So it's interesting, this double taxation, because we are both taxed at corporate level and individual level for C Corporation. What happened then from an individual perspective? We analyzed what happened from a partnership and C Corporation perspective. Let's see what happened from an individual standpoint. So let me start saying that everybody who earns more than a certain amount determined by the IRS working each year in the United States is required to file a U.S. tax return. For non-resident, you must file taxes for every year you are living here and working in the United States. The federal annual tax return required, it's 1040. 1040 NR means non-resident. When you are a tax resident or a tax citizen, so tax resident for tax purposes, and citizen, you have to file a 1040. If you are a non-resident for tax purposes, you have to file a 1040. Typically, the original due date is exactly as C Corp, and it makes sense because these imply paying taxes. So the IRS give an extra month compared to partnership, LLC, and C Corp. That is March 15 if the calendar year is December 31st, the year end of the company. For individual and C Corp, we have until April 15 of the following year to file a tax return. In case we ask an automatic and free extension of 6 months, it goes until October 15, and we have until October 15 to file our taxes. Again, this is just an extension of time to file. It's not an extension of paying taxes. So through projection and through the help of a tax professional, we need to get to a final number by April 15, pay the IRS as much as possible and as close as possible to the final number, and then file the tax return later on. To sum up on this section and the individual tax return, if you are a foreign national living in the United States and earn money, either working a traditional job or through non-traditional means, for example, real estate, interest, dividend, you must file a U.S. income tax return for every year you live in the United States. So as you can see from the presentation, we have an example, a draft of the 1040. This has been released a couple of months ago, August, end of August. Because since the tax cut and the tax changes, the 1040 has changed. So now we have 2 pages. The first page is more an informational page where we have to include our name, address, how many dependent we have. And then the second page is one of the most important, of course, and we have the presentation of our income that goes from line 1 to line 6, and it's divided in wages, so salary, if you are employed by a company, and then we have interest, dividend, if we get pension, or if we receive Social Security benefit by the Social Security Administration here in the United States. Then we have the section of the deduction, standard deduction or itemized deduction. And then, of course, through the individual tax rate, the form calculates automatically how much in taxes we have to pay, or eventually, if we paid already throughout the year, to estimated tax payment. Because I wanted to just mention to you the IRS system is a system that asks the taxpayer to pay taxes as the taxpayer earn incomes. So in March, April, June, September, and December, the taxpayer needs to pay some estimated tax payment according to the income that is made on the way. So in case we pay more estimated tax than it was supposed to be on April 15, then of course we're gonna get a refund that we can receive a check back, or deposit to our bank account, or apply to the following year as first estimated tax payment. Other type of taxes, just briefly mentioning to you, we have wealth taxes, so real property taxes. In the United States, we need to pay property taxes for every property that we own, commercial and individual and personal. We have wealth transfer taxes, we have gift tax, estate tax, then very important consumption taxes, so sales and use tax. In case we sell product, we need to pay sales tax, and then tariffs and duties. To conclude my presentation, I would like to spend a couple of words on franchising to and within the United States. That can be a topic very close to you in case you make your final decision to move or to open a business in the United States. Franchise laws and regulation exist at both the federal, nationwide, and state levels. I will never get tired to mention these double level, state and federal. However, not all the states have franchise laws, and the federal laws do not address some of the issues that are covered by the state law. Therefore, when considering entering the United States market with a franchise concept, I would say it's important to evaluate the laws and the regulation at both federal level and state level in those states in which the business will most likely operate. While federal and state jurisdictions share common definition approaches, there is no universal definition of franchise. Moreover, each jurisdiction has its own mix of exclusions and exemption, as always, for definition of tax and legal matter. Generally, a franchise is defined by the coexistence of three elements, a grant of rights to use another trademark to offer, sell, or distribute goods or services, significant assistance to or control over the grantees, franchisees, therefore business, which may take the form of a prescribed marketing plan. And the third element is the payment of a required fee. So if these three elements exist, the business arrangement is a franchisee, and therefore the franchisor must comply with the applicable federal and state law. Most common structure for foreign party to approach to the United States market by the way of franchising can be established only own US subsidiary, and we mentioned that, so the C corporation. Second one can be a setup of US joint venture with one or more joint venture partners. And then another structure can be grant one sole exclusive license to the United States trademarks for the entire United States, applicable to the franchise operation to an independent United States company. If you have any question, I see there's some question already in the chat. Let me get one of them, and is also a question that now that I see a lot of clients ask, and Patrick mentioned that to me. So it says, do I necessarily have to open and register a company? Well, sometimes foreign company set up an office, workshop, or other US fixed days of operation, but don't formally register a company in the US state as a branch. For the same, I would say for the same reason we mentioned earlier. Example, the US tax authority can require complete detailed information on the worldwide operation, and sometimes we don't want to share this information. And also there can be other risk, fine, penalties, but not complying and opening a company. I would say this is a so the answer is yes. It's almost always necessary to open and register a company in the United States when we do business. And it's very important also from a tax planning standpoint, having an entity and a corporation or partnership, whichever it is, it helps a tax accountant and professional to have a better understanding on the business and to better project the following year's tax. Let's see another question. Can I operate in the United States as a sole proprietorship? Okay, a foreign individual, particularly one that is not a US permanent resident, should normally not operate his business as a sole proprietorship. It's too dangerous from the standpoint of the personal liability. We mentioned in our presentation, the concept of liability is very important, and being a sole proprietorship, it can be very dangerous because you are exposed to any personal liability. All the debts of the sole proprietorship are the personal responsibility of the sole proprietor. So also for tax reason, this form of doing business, we can go into detail later, you can email me, but I bet that this form of doing business in the United States, it's not normally advantageous. So I'm done for my presentation. Patrick, let me know if everything is fine. I want to just mention that whatever question related to accounting and tax that we were not able to answer today, I'm gonna get it and personally answer and send you an email. I hope Patrick has all your contact.
We're gonna stay on the line. We have a few questions that we'll go through, and then we'll send the presentation afterwards. My colleague Elizabeth Tran will go through the questions for you. Okay.
Awesome. Okay.
Great. Thanks.
Thank you so much.
Okay. All right, Luca. The first question that you have on here is the last one that I see is for. Do you see the chat room on the bottom right corner?
Yes.
Yes. Okay. So one of the first questions I see here is, what papers do I need first to start to invest in a franchise?
Which paper do you need to start in a franchise? Okay, first of all, I mean, as you know, Patrick has the expertise, especially in this matter, to give you a consultation on that. From a tax standpoint and accounting standpoint, we need to sit with the client eventually and decide which entity and which tax planning would be better. So about paper, I would say that for every company, we need an EIN number from the IRS that let us open a bank account and start with the process of electing the corporation or the LLC as S corporation, C corporation, or partnership. Other paper related to documentation that we need to submit to the state regulation and government. So in case we have employee, there are some rules. In case we have contract, we have sales, we need to file sales tax. So it's a very wide question, which paper we need. There are a lot of paper necessary. So yeah.
Great, thank you. And then the question comes from Juan. It says, I already have an LLC in Florida. I'm investing in real estate and I would like to have a meeting with you guys if I don't live in the States. Do you have, what are the best ways for them to meet with you?
Okay, we can definitely have conference call or video call. And I know it's not easy. We are not in the same city, so we can get together with our partners as well through conference call, video call. We have offices also up north in New York, so we are able to have our clients anywhere in the world through the help of the technology, or also physically in our office and our location. So I'm more than glad to share my email with you, and you can see in the PowerPoint presentation. You can email me. We can set up a conference call, informal meeting to go through your special needs and try to understand the situation and give you the best advice possible.
Okay, and then the next question, under the E2 visa application, what is the most common company that the franchisee generally sets up?
I didn't have that many clients with E2 personally. I know that our company is starting getting a lot of clients with E2, so we're specializing on that. Which one is the most common company? Again, it depends on the business. It depends on the status of the client, of course, in this case, E2. And it depends on a lot of features that we need to evaluate together with the client. Because we can say an LLC or a C Corp from an international client standpoint would be recommended. But at the same time, for what we mentioned before, that we have some state regulation, and also depending on the business of the client, we cannot ahead of time predetermine which one is the best. The answer is always, and unfortunately, it depends.
Okay, that makes sense. And then Andrea asks, can we get a franchising with an LLC? In the they just wanted to see in the last slide, you did not mention LLC, it says.
Yeah, we can definitely get it. And remember, LLC is just a broad entity, and then according to the election that we make, that the LLC will be treated as tax for tax purposes as a C corporation, so paying taxes, or S corporation or partnership. And in that case, again, we will not have to pay taxes, but it will flow through the individual tax return. So yes.
Okay, and then the next question is the E2 visa franchise company set up by lawyers or by accountants?
Okay, so from a legal standpoint, especially at the beginning, that's why I mentioned earlier the advice of a lawyer. So whatever matters with legal documents, we always refer to attorney that can start the process with the article organization, signing documents, getting together with the state government and the federal government to get the company incorporated or filing article or organization. For what matters, the setup in terms of tax return, accounting, and communication with the IRS, it's more on the accountant side. I would say it's a combination of the two.
Okay, Luca, thank you so much. I think that wraps it up for most of the questions. If you have any more questions, we will send the information of the presentation and video. It would be on Visa Franchise's YouTube, and we'll send the PowerPoint over via email. So other further questions, you can email Visa Franchise for the E2 Visa business investment recommendation needs. And for accounting purposes and understanding more, you can reach out to Luca at Prager Metis. Thank you so much for attending this webinar, and we look forward to hearing back from you soon. Thank you. And thank you so much, Luca, for being a part of this and for really giving some great information, insight for all of us.
Thank you so much.
Thank you. Take care.